particularly now as people are now into 2009, finishing up their 2008 returns, or maybe have a good idea of what they think they're going to owe, and now thinking, okay, what do I need to do in 2009 in terms of estimated taxes? I've got this provision now that says, hey, I can reduce that amount, hold back on to a little more working capital over the course of the year, and then pony up if I will at the time that I prepare and file my 2009 tax return. Okay. I mentioned earlier COBRA. COBRA is actually is an acronym for I think it was an 85 or 86 tax bill, Consolidated Omnibus Budget Reconciliation Act. It's big names that they put, but the COBRA rule deals with health insurance under a qualified employer-sponsored plan. What COBRA allows, and any of you that are conducting businesses probably know this rule, if an individual is terminated, he or she is entitled to continue their health coverage. On their nickel, they have to pay the premium. They have to pay the same premium that it's costing the employer, not what they were having withheld by virtue of being an employee, but what it's costing the employer, plus a 2% administration fee, if you will. So you pay 102% of your premium, but at least allows people to continue to have health insurance. And under COBRA currently, you can hold on to that insurance for up to 18 months, after which it no longer applies. You've got to go out and get your own policy if you haven't reemployed and have a new policy. I think the concern on the part of the administration is with so much going on in terms of layoffs, unemployment, lots of people out there in the marketplace now who have been laid off, were covered under an employer-sponsored plan, but suddenly have to find a way to pay 102% of the premium that was costing the employer to continue that coverage. So they set forth a significant amount of money in the budget, in the Stimulus Act, to subsidize that payment. And what it allows is an involuntarily terminated employee to continue that coverage for up to 9 months, not the full 18, for up to 9 months, and only pay 35% versus 102% of what that premium would otherwise cost them absent this provision. COBRA doesn't apply unless you've got a business with at least 20 employees. You have to be terminated between September of last year and the end of this year. Again, we're focused on this period that we're in right now, where we're seeing unemployment numbers that we haven't seen in a long, long time. The subsidy is not taxable. General rule would say, hey, I just saved 65% of my health insurance premium. I've gained an economic benefit. I ought to pay tax on that. Well, you don't have to pay tax on that unless you're high wealth. And the high wealth rule says that at $125,000 for singles, $250,000 for individuals, if my adjusted gross income on the return for the year that I was terminated exceeds that threshold, there's a phase-out period, but ultimately you're going to have to pay all of that subsidy back through your tax return as an additional payment element. I was telling somebody earlier, one of the write-ups that I read on this provision used the example, I don't know how accurate or applicable this example is, but it used the example of a Wall Street broker who was laid off because of what's going on midway through the year, or maybe I guess we could say late in the year of '08, had made roughly $1 million before he got laid off. He or she is eligible for this provision, at least initially to only have to pay 35%, but because they've already earned well above the $250 limit for that particular year, they're going to have to pay it back. But it does give everybody, some degree of deferment, if you will, of having to pay back the subsidy.
If you're an individual in that situation, would you just contact your health insurance provider to apply?
The way it's going to, the question is, do you contact your employer, your provider, if you're in this situation? Well, the way COBRA works is that the company is automatically required to provide you all the information necessary for you to continue that coverage, continue the COBRA coverage. And now they will have to simply administratively reduce that premium. I think it's probably going to come directly from the insurance company.
It's probably an automatic thing. I mean, if you were in this situation, you wouldn't necessarily have to go through a process.
No. When you go on COBRA, You leave the relationship with the employer.
Right.
You build a relationship with the insurance carrier. So it's going to be, instead of you paying 102% of the premium to the insurance carrier, you're going to pay 35% of the premium.
Right, I'm saying that the health
No, wait a minute,
insurance.
my small businesses, they pay, it pays, the employee, former employee pays it to the employer, not to the insurance company.
It can go either way.
That can go either way.
And
There can be a TPA.
this is what my company does, is help employers sort this out. If anybody wants, we have a white paper on this that I can send you, if you give me your card or something, but there are some notification requirements in the bill. It also goes all the way back to 9/10, so it is retroactive.
That's what I'm asking, yeah.
Yeah, and it also opens up the time frame. Let's say you had an elected COBRA. Normally you have, I don't know whether it's 60 or 90 days, I forget, but I think they
it's
opened
60.
that time frame up as well. So there's a number of additional little caveats, if you will, that make more people probably eligible for this than we normally do.
But there is a tax tie-in. You could look at this provision and say, what's it doing in Mark's presentation on taxes? Because it's not a tax issue. There is a tax element to it, and that the element comes into play with respect to the situations where employers are actually continuing to pay the premium to the insurance company.
Right.
And they would continue to pay the full amount to the insurance company, whatever that's costing to cover that employee, and they claim a benefit, or they claim the subsidy back from the federal government through their quarterly unemployment filings.
Okay.
So their quarterly tax filings is the way they get that money back.
Okay.
And
So is it only 65% of what the employee's cost was, or what if they had family
it's
coverage that they were?
it's whatever coverage you were on. You can continue your family coverage. If, let's say, I'm an employee and I had elected family coverage, it's 65%.
Even if the employer wasn't paying for the family coverage?
Right.
65%
Yes.
of total insurance.
It's 65% of your total insurance cost.
There could be a scenario where the employee's cost would go down.
Yeah, except for not having a job, that'd be a good deal.
Mike, it's absolutely going to go down. I mean, the employee's cost will absolutely go down.
They would go down. Again, remember, they're not. Once you go on COBRA, absent this rule under old law, you're not continuing to pay what was being withheld, for example, from your, because that number is a subsidized number to begin with because you're in a group health insurance plan. You have to look at what it's actually costing the employer to cover you while you're in the context of that plan. That becomes your number or your cost once you're terminated. That number then is reduced by 65%. And that subsidy, if you will, is the responsibility of the federal government, and you as an employer get that back through your quarterly tax filings.
What happens, because I have a client in this situation, at September 1st, they had 35 employees. Okay, so they were qualified for this. At January 1st, they've got 8 employees.
The question is, what happens if you go from 35 employees down to 8 or below the 20? I'm honestly, I don't know the answer to that.
They're eligible for COBRA when they made the reduction.
Right.
I would think that that would
So it goes back
apply.
to September 10th.
So it will roll back.
I would hope that's the way it was. I honestly
Right, yeah,
didn't
that's
look at
a
that
complicated
provision.
situation,
But if that weren't the case, and I guess you could say, well, what benefit is this providing to anybody if I can't get people who were eligible before we have obviously this very significant downturn and people being laid off? It wouldn't make any sense
Right.
otherwise.
I can understand the taxable part, but you said some of this may have to get paid back.
Some of it has to be get paid. If you're a high-income, quote, high-income individual who was terminated,
Right.
you're still eligible. There's no discrimination from that standpoint.
Right.
You can gain the benefit of paying 35% for the next 9 months if you don't get employed again or get under a new policy. But you would then have to pay that subsidy back. In other words,
So it's the subsidy is not only taxable, you have to pay it back to the
well,
government.
you pay it back through taxes. In other words, if let's use an example. If it was going to cost me $100 for my premium post being terminated,
Right,
I now only have to pay $35
right,
to the insurance company or to the employer
right.
for 9 months. That $65 difference comes back into,
It's taxable income.
well, it's actually going to be, that's dollar for dollar. You're going to have to pay that back in tax. Because that's the benefit that you've
Okay,
you've
so
generated.
it's not just taxable income, you want
No,
that money back.
that's the money.
Getting a loan.
You're basically getting, that's exactly right. You're getting a loan for,
So it's not a subsidy at all,
$65 a
it's
month.
just a loan for higher.
it's just a loan for higher income people. Interest-free, but still, it's just a loan.